So is there a way to predict future cap rates? Crystal ball section again, so there's all assumptions that go into this, but there are rules of thumb that you can use to make reasonable projections of where cap rates will be in the future. And one of the accepted or established ways to do that is you look at inflation, or in this case, we'll look at the inflation target. So the Fed stated target is 2%, so just for giving a little margin, I say 2 to 2.5% is kind of your starting point for how do you figure out cap rates. On top of that, the 10-year Treasury, which is considered the no-risk alternative to investing in, a piece of property that has tenants and toilets and troubles and all that kind of stuff. The no-risk alternative is the 10-year Treasury. That is usually about 1 point above whatever the inflation rate is. So if it's 2 to 2.5 for inflation, then you got about 3 to 3.5 for the 10-year Treasury. As it stands this morning, I think it's 4.25 is what the 10-year Treasury. So if we actually hit the inflation target that the Fed's after, then it's conceivable that that would come down. So on top of that, so if your alternative, the 10-year Treasury is your no-risk alternative, then what do you need to get to take the risk? Have tenants and toilets and troubles and all that sort of thing that go along with commercial real estate. So depending upon the asset type, I think Connor mentioned that it's 2 to 2.25, which is accurate for certain single-tenant net lease deals that have high credit tenants. But for apartments, and I would say most things, the risk premium is generally 250 to 400, 0.5 to 4% above whatever the 10-year Treasury is. So that is what will drive the asset valuations more so even than the cost of money in terms of the interest rate. It's really the spread over the 10-year Treasury. So when you add all that up, it means that your exit cap rate in the future, your implied future cap rate, is somewhere between 5.5 to 7.5. So there's a range of risk inside of commercial real estate investment. And so you might have apartments, a brand new apartment building, fully occupied, Class A, that may be on the lower end of the band. Hotels maybe are in the middle. And then if you've got some sort of property in a bad part of town, or it's got deferred maintenance or something like that, and you go and acquire that with short-term leases and not very good tenants, then your cap rates would be on the farther side, the higher side of the risk spectrum. So if all these are accurate, and these have generally been accepted over the last 70 years as to look at cap rates in the future, you would anticipate that you'll have between 5.5 and 7.5. So why is that important? Give a couple examples throughout the afternoon here of where that would play in. But if you, just as an example, if you apartment building in 2021, a lot of people did, and it created $100,000 in net operating income, and you bought it at a 4.5 cap, that would mean that you paid about $2.2 million for it. 2 years later, if this is all accurate and the implied cap rates come out as we think here and say it's 5.5%, then and your net operating income is the same, then that asset is now worth $1.8 million plus or minus. That's about a 22% decline in value, assuming everything stays the same in terms of the NOI. So if you are a seller and you need to liquidate that asset, are you willing to take a 22% haircut on your property? So far, not many people have been, but as time progresses and loans term out and that sort of thing, more of those conversations will become percolating to the surface.